And I would argue that's part of what we're seeing in the markets. We're seeing dramatically higher levels of what's referred to as skew. The market is pricing the deep out of the money, the true risk options that the market collapses by 50% or more over the course of a year. Those are being priced at the highest premiums relative to realized volatility that we've ever seen in history. The market senses something is wrong.
Yeah, but then how does this whole thing turn? I mean, if there's so much index, funds out there and they need to keep buying to rebalance, then what's going to cause the indexes to drop?
Well, I think there's two things that cause it to drop, right? One is that the larger passive gets as a share of investment, the less of a, what I would refer to as a quanta, or the less selling is required to stimulate a collapse in the market. Right. So I would point to what happened last March. And the way I would describe the pandemic collapse is active managers sat there in the January, February, very beginning of March period, deeply confused because this was not concealed, right? We knew the pandemic was occurring. We knew that China was shutting down, right? We knew that Italy was in serious problems, that the US began to see cases in New York, et cetera. And yet the markets appeared to levitate, right? For someone who's looking to the market information for the quote unquote expectations channel, what is actually happening, that's confusing, right? And you heard Bill Ackman and others talk about it, like something's wrong, I don't know what's going on, my spidey sense is tingling, I'm gonna go out and buy insurance, right? And he bought credit default swaps. What we saw happen in those events is finally the active investor community broke. They tried to de-risk and they found there was nobody to buy from them, right? Because the passive managers, the minute they've bought what has been handed to them in dollar terms, they don't look at it and say, oh, the market is on sale, let's buy more, right? They're full, that's it. Right. They don't show up. And so it contributes to what is mechanically referred to as an increase in inelasticity in the market, right? And so inelasticity is effectively how much does price change for a change in supply and demand. And the really staggering statistic, Vanguard released this as a point of pride. They noted that less than 1% of their customers transacted in an unusual manner around March 2020, right? Now,
so 1%, okay.
1%, right? Now my reaction is, what would have happened if it was 2 or 3, right?
Right.
And my simulations basically suggest that creates conditions very similar to what we saw transpire with the XIV, where in a single day, it went to 0.